And welcome back to the Lance Roberts Show podcast. I'm your host, Lance Roberts. Peter Eliades, Stockmarket Cycles, has been around for 46 years. Technical stock market timing experience. Peter knows more about the technical ins and outs of the markets than probably just about anybody else on the planet. And, he loves the markets. And just as any good technical trader does, any technician, they actually love the financial markets. And, of course, that's Peter. Peter, welcome to the show today. How are you, sir?
I'm doing great. Thanks for the welcome and thanks for the invitation, Lance.
Yeah, no, absolutely. You've been around for, this whole market, I guess, probably just about as long as anybody that's been here. Through all of your time of being involved in the financial markets, what's your one piece of kind of knowledge that if you could impart to everybody, say, this is the one thing you really need to know about the markets?
Well, we talk about technical factors so often, and everyone's got their own favorite little indicator, and everyone likes to look at one area of the market or another in terms of industry groups, whatever. I don't do industry work, by the way, but a lot of people do that, and I respect the work that they do in it. But I have always said, in fact, I have an old buddy in the business, Robert Prechter, and Bob and I talk a lot about the markets. And we got interviewed together. This is like 25 years ago. We were both on the cover of Futures magazine. And when we were interviewed, there's one thing we agreed on, Lance, and that is there are so many different indicators in the market. Mm-hmm. The most important indicator of all, and this is not a revelation, but it's a truism, the most important element of analysis of the markets, whether it be technical or fundamental, regardless of the indicators that you're looking at or anything else, the most important element of all is price itself.
Right. And I don't think enough people give enough weight to the issue of price. I was just having a conversation earlier today, and, the conversation is, well, the markets just go up over time. And, yeah, that's true. But, there are times where you don't want to be in the market and things can really go against you and can really take away a lot of your money. And, people just seem to ignore what price is trying to tell you about the markets in the short term. I mean, at the end of the day, the stock market is a market. There are buyers and there are sellers. And the price tells you what buyers and sellers are thinking about the value of stocks, right?
Absolutely. And it gives, in so many different ways where people will say, well, I would sell it if it gets to this level, or I would buy it if it gets down to here. And they trick themselves because a lot of times it'll go up to where they said that they thought they would mm-hmm. sell. And they say, well, no, I don't know, man. This looks really good. I want to hang in a little longer. And so you have the greed element come in.
Right.
And on the downside, exactly the opposite. It's like someone said, well, I know I said if it went down to 35, I would sell it, but I hate to sell it here, man. I'm losing like 10 points on this stock, mm-hmm. and I'm going to wait till it rallies a little bit.
Right.
So, and they don't pay attention to the price that they had already preordained would make them do something, and they ignore the price.
Right. Well, they say that people only find religion in foxholes, but you also find it in big price declines as well, because at some point that price declines far enough where you start going, okay, God, if you'll just let the stock come back a little bit, I'll sell it. I'll never trade stocks again.
Absolutely. Yeah, that's true. That's the psychology of the market.
Yeah. So let's fast forward to today. I mean, look, you've been through the crash of '87. You've seen the crash of 1999, 2000. You saw the 2008 financial crisis. Does today look any different than previous concerns, or are you starting to see a more negative backdrop starting to develop here with what's going on with particularly the FANG stocks in particular?
Yeah, there's always a difference, Lance, but boy, there are so many similarities now. We've been technicians love to play with analogs, and you mm-hmm. say, well, boy, look at this chart. Doesn't that look a lot like
right.
XYZ year or whatever? So you can do some analogs with the current market in both 1929 and 1987. You have to be really careful with analogs, though, because if you get yourself hung up on them, you can you can go too far and say, well, yes, it broke from the analog today, but I'm going to give it another couple of days because I know this is going to happen.
Right.
We are running really close to the 1929 analog now. And if we do that, then in the next day or two, we should close below the lows of October 29th. And from there, there's another 15, 20% or more to the downside very quickly. So that's the way that analog runs.
Right.
I love analogs and I hate them at the same time because, you know, if you tell people there's an analog and they see you on the street 2 weeks later and say, you know, I went out and shorted the market with all my money because you told me this was 1929.
Right.
You say, no, you have to pay attention to the market each and every day because things can change that quickly. So can we have that kind of decline? Yeah, we're set up for that kind of decline. There are several arguments against it, though. As I'm sure you know, Lance, we're coming into a period between, usually it starts in mid-November, but sometimes towards the end of November. The end of November bottom, I remember best of all, is 1971.
Right.
There was a really strong bottom that I think was, if I had to guess, I'd say November 26th, but it was right at the end of November, and the rest of the year did very well. There's a tendency for the market coming into this seasonality of November, December. We have our two big holidays of Thanksgiving and Christmas. There's a tendency for that to be a bullish period.
Right.
Not only that, but we're working, if you're bearish, you're working against another seasonality factor.
Right.
Within the 4-year presidential cycle of 48 months, the best 9 months within that 48 months takes place from the beginning of October, in other words, the end of the third quarter, so beginning of October to the end of June of the following year, beginning of October of the midterm election year within the presidential cycle into the end of June of the following year.
Right.
If you go back and look at those 9-month periods, going back 50, 60, 70 years, you'd be hard-pressed to find one of those 9-month periods that's down. I'm not saying it's never happened, but I'd say the odds are as high as 80 to 90% of the prior times that we've seen that. And of course, it only happens every 4 years, so you don't have that many to compare it with. In the last 60 years, there'd be 15 of them. But almost invariably, that time period is up. It tends to be the most bullish 9 months within the 48-month presidential cycle. So we're fighting against that if you want to be a bear. But despite that, I see enough things out there that make me continue to be guarded and negative about the overall market outlook.
Let's hold on to that thought real quick, because you've laid out a really interesting dichotomy here, right? So we've got one bullish thing to look at. We've got a lot of bearish indicators to look at. So when we come back from this quick break, Peter, let's talk a little bit about how, as an investor, should I play it? Should I just hang on with what I've got and hope not to have the downside? Or what do I do? Because if I get out and the market runs up, now I've got to get back in. So it's one of those hard things to do for investors. And we'll talk about that with Peter Eliades right after the break. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.